All right, so it has now come the noon hour in which we will give you all a backstage pass to our strategy meeting. We did this last month and it went over really well with the listening community, so we're going to attempt to do it again. And that means we're going to bring in a good portion of our trading team: chart trader, event trader, blue chip trader, and scalp trader. So I want to wish you all a good morning.
Morning.
Morning, Jim.
Hey, good morning to you all. And I think I'm going to start with you, Brett, chart trader, because we had a very interesting dynamic with the Fed going on and the dollar index. Now, I'm sure that you've probably put this into perspective, but it is pretty recent, so I don't know how much you've actually done all the research for that, but considering it's a very fresh component to what we have going on in the market today, what's your overall takeaway, and then how you're going to look at things moving forward?
So I think that we're at a point where obviously the Fed came in at the, let's say, the dovish end of expectations for what was possible yesterday. They did set a definite date for the balance sheet. It was kind of at the dovish end of expectations. They did take their dot plot all the way down to the Fed funds futures at no hikes for the year. So they're about as easy as you think they could be, but they also preserve the sense that they can couch this as part of a sense of international risks to the global economy and things like the trade war and Brexit and what's going on with European banks and looking at that as a reason to stay on pause. So they're essentially possibly fueling the greatest growth potential that you could see of any major economy. And I think that's why the dollar's reacting the way that it is today, because their measures actually can make a difference. And it may be something that we see over the next quarter or two, that they start to need to backtrack on that dovishness. So once you digest the situation, the future potential for the U.S. economy, I think, is probably looking better than other major economies in terms of where it is in the cycle. It could possibly have another serious leg to the cycle, whereas it's hard to conceive of that in Europe and Japan right now. So I think that's why the dollar is really, zipping back the other way despite the dovishness that we shifted to yesterday. It's what that dovishness is going to do for the economy. So I think that's what we're seeing today.
All right. And then as far as what you're looking for in the markets, do you expect us to have maybe an uptick in volatility, or are we just going to sit around?
So I think that one of the dynamics we talked about yesterday quite a bit is that when the Fed comes out, there's always this period of digestion. And the initial knee-jerk reaction that you see, and even what you see several hours later, and even what you see overnight, isn't necessarily indicative of how the market is eventually going to take that information. And that sometimes it needs to be, midway through the morning the next day that you start to get a definite sense of direction. And I think that we're seeing that right now. And I would say one way to think about this is it was the dovish end of expectations, and it did preserve the sense that the U.S. economy is still strong, and yet we're being this dovish. And I think that's a great marketing piece for people who then start to call clients and say, you've got to be in this market. And I think that we just had we came in today most likely with a lot of folks that had lined up at the door, and when the bell rang, they need to increase their exposure based on how the Fed dealt with things yesterday. So I think we're starting to see that rip, and it's possible that this could continue. We'll know as we see the sentiment data evolve and the exposure data evolve whether or not this is a mad rush, a mad scramble that's going to peter out over a couple of days, and then we start to go ahead and consolidate and correct things a bit, or if there really is that much money that's been sitting on the sidelines and that needs to get involved. And it's more of a case of just tracking the mode of behavior. But this initial shotgun in, I think, is just a lot of people lining up at the door for the bell today. But one other point that I would want to kind of point out that I've just noticed is a report that CNBC put out earlier today that apparently, according to their sources, that Trump is starting to really push for a deficit reduction focus to the trade war. And there's been this tension between one side of it, which we can think of kind of as the Trump side of it, and the other side of it as maybe the Lighthizer side of it, of how we strategize around what's really necessary and sufficient for there to be a signed trade war. And the Lighthizer side of it is really about the long-term structural ramifications of China's push to become essentially the technology infrastructure superpower of the world, and trying to prevent that from happening and prevent some of the IP infringement in terms of the way that they deal with foreign technology companies. And the Trump side of it maybe is about being able to take gushers of money back to his base and say, here's how I dealt with that deficit. Here's a big short-term pop in your pockets, and especially coming in front of the election. And if this report is true, then the shift to where Trump is maybe starting to tell Lighthizer to go sit in the corner while he takes over the negotiation to some extent, that massively increases the likelihood that we get a deal, because China is definitely willing to write a big check. And they really don't want to give up on their future, 10, 20-year plan and to shackle themselves to something that's really going to take away the possibility through enforcement of becoming that, technology infrastructure superpower. So this really could be part of the narrative today if that report is true, if that kind of inside scoop is true, because that has the ring of truth to me of how this might go at this point. To want to close this out with something that is, at the end of the day, maximizing short-term gains for the base, for the president, well in front of campaigning for the next election, and in ways that are very easy to understand and easy to market in a campaign, which is, here's a lot of money for you. I went and got a lot of money for you. So I could see that being true, and if true, that does really increase the chances that we do close out the trade war and remove the tariffs, even though we made that threat yesterday. So that's another aspect of the situation. But finally, the other thing that I've been watching more closely is the way that oil is behaving, and there's a narrative there that we've talked about, which is essentially that the refiners got too low on gasoline stocks relative to expectations, and they've started to rebuild that, and we see that in something called the crack spread, which we've talked about a few times, where you're basically seeing the lack of gasoline stocks as well as a moment-to-moment increasing incentive to turn any new barrel of oil into a barrel of gasoline, and that really is the most important demand function for oil. So we're finally starting to see oil move back above the 60 level, and as you and I suggested last week, we might see a test of that 63 to 65 area, and that's also something that kind of feeds into all of this, of an increasing cyclical attention in the markets, because you start to pick up, it's not just the technology companies, you start to get some of the materials back in, some of the energies back in, but the one thing that's lagging, obviously, the one kind of casualty of what the Fed did is the banks, and we'll see how they react. Maybe they'll react like the dollar. Maybe they'll start to rally on the idea that that the Fed's not going to be able to stay where it is. But the yield curve is really compressed right now, so the financials are just lagging badly.
Well, they're lagging badly, but I will say this much. They've retraced a lot of their losses for the day. They were down over 1%, and now they're down just 0.3%, so clawing back pretty nicely.
Yeah, absolutely. But if you look at the last 3 to 5 days, and relative to the rest of the market, they've got a lot of catching up to do. It'll be interesting to see how that plays out. All
right. You didn't do anything in gold though yesterday, did you?
No.
Didn't quite get that set up, did you?
I still believe patience will be a virtue. I still believe we will get that shakeout. And that really, again, that's how the setup becomes structured right to me. So there's no reason in worrying about chasing it. I don't do white whales. I've done white whales in the past, and it never really works out terrific. If you feel like there's something you have to be in no matter what, and you keep trying, you keep worrying about it getting away from you, and you keep chasing it and putting yourself in a difficult position, not a power position, I think that just isn't worth it. So I know the level I want it at. I'm going to let it play out. I believe that it will give me that level, but again, that's that shakeout under 1275.
All right, and just based on some of the things you're saying, you don't really seem to think that volatility is going to pick up all that much in the coming month.
Well, again, I think that it's the mode of behavior coming out of this. Is this a short-term rush? There was a bunch of money lined up at the door today, and it's not really the case that we're going to just keep sucking it in. In which case we could have a 1 to 2 day big pop that really kind of blows things off, and then we start to pick up the ability to correct and consolidate, and then we've got levels to check, and then we put in a kind of consolidation pattern during which there will be moments of volatility. Or is this the case that there's just so much money that had been forsaking this market, which is possible, that we really just start to sprint all the way basically straight back to test the all-time highs? And in which case it is possible that we'll see a VIX rise along the way, which is unusual, but it does happen in situations where large money managers are malpositioned and they have to start to hedge for essentially what you might think of as an upside crash because they're trailing the benchmark too much, and it comes in the form of options buys. And with, further and further out, away from strike prices, out of the money, speculative sort of protection catastrophe hedges for a massive move higher when they don't have the exposure to the market. So you see that every once in a while when people are very pessimistic and the market starts to really charge higher. You can actually get increasing volatility on the upside.
Based on the put-call ratio, have you? I know you're paying attention to it, but does this get you at least thinking about putting on a short?
Not yet.
Okay.
If you look at things like periods like the end of September, you can have this kind of moving around the 0.6 area for several days. If it really solidifies there consistently for a number of days, it starts to make me feel like I want to use that as a contrarian indicator. Mm-hmm. But usually I look at it as a contrarian indicator on the other side of the spectrum because, again, the panic side of the put-call ratio is much more compelling in market inflections than if it's just drifting around 0.6 to 0.7. It usually isn't as good a timing instrument.
Yeah, I don't think it's very good at timing. Maybe somewhat of complacency.
Yeah.
I haven't done a study on that, but I bet there's something out there.
Yeah, sure. I mean, if you look at like a 10-day average of it, if that gets low enough and sits there, then you know that you're building into a situation where you've got a tremendous amount of complacency, mm-hmm. and there's vulnerability there. Right. And then if you get something else that puts you past the tipping point, some kind of catalyst or something, quickly people start to scramble to the other end of the spectrum.
All right. Anything else before we jump over to Gavin?
No, I think that pretty much covers it.
Okay. All right, Gavin, you're next up, and would love to get your thoughts on what you're seeing in the market and what you think we might be seeing ahead of time.
Yeah, I mean, there's a couple of aspects that I'm watching right here. I know Brett had spoken a lot about a number of them. For the Fed, there was certainly a dovish turn by him yesterday that, bears watching, and Brett and I were talking a little bit about that 1998 move by the Fed following the LTCM issues, where it was more of a global issue than a U.S. issue, and when they made that dovish tilt, it really provided the boost for a bubble. So wanted to see how that plays out in the markets in the coming months. But there's a few things that are going to make things a little bit more interesting here. I know Brett was talking about the trade. From my perspective, I've seen a number of stories coming out about how the president's trying to negotiate this, and I do think that there's some merit to the story beyond today. We'll get some better ideas next week when Mnuchin and Lighthizer comes out, but for me, I think that this could get pushed out a little bit further because I see both sides really having some trepidation on signing a deal because neither one trusts the other side. Pretty tough to get a deal done when you're looking at two sides that don't trust each other, and therefore I don't think either one's in a rush to do anything just yet. I don't think China felt a bunch of economic pain here, but they're able to deal with that a little bit more. We're still a good 14, 15 months away from the election cycle, so I think Trump is content with dealing with a little bit more pain too in order not to make it look like he's rolling over and doing too easy of a deal on China. So I think that's going to get pushed out into that June summer time frame before we really see any sort of deal announced, and I'll be curious to see how the market would react to any sort of delays on that front. The other side being, of course, the Brexit issues, which right now it looks like next week we're set to see a little bit of chicken going on between the EU and the UK on who's going to blink first in terms of the extension that the UK is going to ask for. I think eventually the UK will have to blink and look for a longer-term extension. But these are two headwinds that are coming at a pretty key resistance levels here. I know we're back up to them. And it's going to basically set the table for a little bit of a concern in markets going into this Q1 earnings season, and that I think is going to be the real determinant on whether or not we're going to break out of these issues or these levels. And I'm a little nervous with what I've seen from FedEx, Caterpillar, Samsung. The Micron report yesterday continued to point towards a second half recovery, but that's not going to come for another couple of months. And therefore, I think semiconductors will continue to post some weak results, and I'm curious to see how the market's going to react to that. And for me, I just don't see the need in getting overly aggressive until we start getting some of those Q1 earnings out. But if we are able to pass the Q1 earnings season, then that bubble's setting up here, and I think it's really a U.S. dynamic that could see the IWM be a big winner, and some of these cloud computing plays really continue to start developing that bubble space, kind of what we were seeing back in 98 and stuff with the internet names when they just really took off, because people are going to be looking for places to put money. If Europe continues to stumble and those trade wars force China to stumble, the U.S. could certainly be the clean sheet in the laundry, and we could see money moving into it. So the next few weeks for me are really going to help develop which way we go. Until then, I think we're going to see a little bit of a chop forward. Now, if we get a positive development on trade next week or the UK, that obviously throws away my current thesis. But that's kind of how I'm seeing things playing out now. So just watching that. We also want to get a little bit more color behind this balance sheet unwind by the Fed on whether or not they're planning on sloping that curve, and that's going to be key for financials and key for financials moving forward in terms, and as well as loan growth in that Q1 earnings season. And I don't see the market taking off without the help of the financial group. So that continues to be a key area for me to watch.
All right. Scott, do you want to jump in and give your context? I do want to give you credit. You were very, very bullish, probably the most bullish out of all coming into this quarter. And I apologize if I'm forgetting anything, but I do just remember Blue Chip Trader's tone last month and how bullish he was, and turned out to be very right. So anxious to hear what you have to say about your thoughts for the next month or so.
Yeah, I mean, it wasn't any secret or anything like that. I'm always on air here explaining exactly what I'm looking at on the charts. And the main reason behind why I remain somewhat bullish in this market, or strongly bullish than most people sounded, I guess, was the advanced decline line. That's the cumulative advanced decline line on the New York Stock Exchange. I posted underneath my swing trader column a few weeks ago. And while the advanced decline line was climbing and actually making its way above the Q1 highs and pushing towards all-time highs, you didn't see that same type of behavior going on in the major indices themselves. And I kept talking about how sometimes the major indices are not a good indication of the current bull or bear cycle that might be in play there. And it's just the way that the system's designed. Sometimes you got to look a little deeper under the hood to see what's really moving the market around. If you just focused on market cap weighted indices or price weighted indices, or even the ETFs, which are also guilty of being heavily weighted or skewed towards one particular or two particular stocks, you're not going to really, you're going to miss the bigger picture, so to speak. And I've always been a big fan of watching the AD lines, because that just treats everything on a more equal basis. Now, I know there's equal weighted ETFs and funds out there, so obviously those are good tracking devices as well. But I've always found the AD line just always gave a better sense of bullish and bearish cycles. Combined with the fact that we just, in early March when we started, that was like the first pullback we saw in 2 months, and it seemed like all the bears came out of the woodwork just saying, that's it, trend's over, we're rolling back, we're testing the October lows, the December lows, blah, 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 etc. And it just got so aggressively bearish from what I could tell from just listening to commentary and just reading a few tweets out there of the few people I follow. And I was like, this is just out of control. I can't believe how bearish people are, and the AD line's making new highs. So yeah, and it just worked out in my favor. I mean, sometimes I get lucky by sticking with the trends that are at hand. Yeah, and that's basically where it is, and it's the same groups that are leading to the upside here. It's mostly technology driven here in Q1. It's software names, cloud names, security names, semiconductor names. They all look fantastic. You can take a look at either one of those ETFs. There was some hesitation in the FANG stocks. During February, there was some very unusual narrow range price activity going on in Apple and Amazon. even NVIDIA and Google to some degree. You're just looking at these names and saying, wow, what is going on in there? They just weren't participating, and everyone's kept focusing on these mega cap names saying, oh, the market's not going higher because of, and it was just more of the market doing what it does best, which is fooling a lot of people most of the time. And you really, like I said, you got to look a little deeper for opportunities when things aren't lining up properly. And yeah, we capitalized on a lot of those movements, and then now we have Apple and Netflix and Amazon and Google just taking off here in March, helping put a bit underneath the market. Recently, I've been a little bit concerned with the small caps as a whole, IWM and mid caps, not participating above the February and March highs, similar to the way that the NASDAQ and the S&P is. And if you look at the heavyweights and the SPY and the QQQs, it's all tech related right now. It's all Amazon, Apple, Microsoft, Google. And I'm curious, why do they put both Google stocks in there? That seems like almost like a double weighting for that name. But anyway, it's just very skewed technology side right now for the S&P and the NASDAQ. And so I do have my reservations based upon the small caps and mid caps being the more speculative asset group that's not leading the way to the upside. I think today's effort is pretty decent so far, and maybe they start to play catch up with the larger group right now. The advanced decline line is still trading at all-time new highs, so I have to have this general bullish tone in the way I'm approaching the markets. But I'm still, like I said, I still have my reservations with the current small cap, mid cap performance levels. I think maybe the market might still be in this ranging territory action. And it's a wide range, obviously. I'm not talking about day-to-day fluctuations. I'm talking more on a week-by-week basis as we go into the end of March into early April. But overall, that's pretty much where I'm sitting right now at the market, just focusing on the rotation out there in certain groups and capitalizing on some leaders, specifically from the liquid momentum focus list.
All right, and that leaves Damon up to bat. So, Damon, how do the stars line up for you as far as some of the things that you're looking at?
You know, I normally look at things from a relative value standpoint and really don't try to make predictions on the market. I think the last time we spoke, I was somewhat bullish in terms of feeling very strongly that people got left on the sidelines of this rally. Like I said at that time, unless you cancel your Christmas vacation and you're here ready to act, then you miss the move for the most part. And I think most institutions look forward to their holidays, so institutional traders or fund managers. So I don't think there are many people around to participate in that major rally off the December 24 lows, and felt that pullbacks would be bought. My general approach has been to go after some of the kind of smaller mid-cap names that tended to not participate quite as strongly in the market rally, and also offered attractive valuations, and it's played out pretty well. 10-year is down to 251 today, 2.51%, which makes the yield complex a lot more attractive. I mean, there were, a few months ago, people were concerned about rates going to 3.5 plus on the 10-year, and now we're back to 250. So, makes high yield stuff a lot more attractive. Today I added a position in a MLP with a 9% distribution yield, and that MLPs have been out of favor because of the concern of rising interest rates, which make their yields less attractive, as well as these are capital-intensive businesses, so it makes the idea of refinancing debt less attractive. Well, a less attractive environment for them, which compresses cash flow, discounted cash flow. So I think that some of these MLPs could start to bounce with the pullback or decline in yields.
All right, and so you usually do something more advantageously, looking for different gaps and whatnot, so prognosticating for the actual market itself is probably not really your game plan. So are there any any of those that are catching your attention, though? Some of those day trade opportunities?
Well, the intraday action has not been very attractive the past week or so. Since earnings season ended, you've had, really just, it feels like a decline in volatility. I mean, the VIX is now 1355, which tells you a lot. I mean, just given that, just where we were just a few months ago, and people felt like the world was coming to an end, the bull market had ended, people were unloading positions, and now it's, business as usual. In terms of kind of what we've seen from the past several years in terms of that steady uptrend. So, yeah, I'm just kind of sitting back and just seeing how things play out. Again, one of the things I try to do, when there's an opportunity, is pick up these compelling yield names, because they'll pay you even when times are slow. And so I kind of have change things up, have a variety of different strategies, because the one place you don't want to be is stuck in a strategy that's not working, right? So if you're a day trader and you've been trying to just day trade the past couple of weeks, that probably hasn't gone well for you, because the real opportunity has been just sitting there patiently and letting your swing positions work. And day trading, so if you try to short anything, you probably have gotten your head handed to you. And it's really hard to be a buyer of a lot of these things, just because the price action is so extended. I mean, it really feels like there's a massive short squeeze. And so from a trading perspective, just not really ideal conditions. So it makes sense to have on some swing positions. At least it has made sense the past several weeks. Mix it up, at least for me, mix it up with some income stuff, and then just wait on spikes in volatility to take advantage of short-term trading opportunities.
All right. Speaking of, I don't want to say I was surprised that you didn't go after Biogen today, but I would really love your analysis, because I know it hit your radar, and was just curious what your thoughts were. So Biogen's a big cap biotech name. There's a lot of people making valuation decisions on Biogen today. It's not a day trading name. It's just too big for that. Okay. So, all right.
I like stuff that has an edge to it. Biogen, I think the only way you can look at Biogen is from an investment standpoint, right? Like, people are running the numbers in real time, trying to decide, is this a compelling opportunity for the next 10 years? And those are the people who are making the decisions in that stock.
All right.
Hey, Jim, let me jump in there. I'll give my 2 cents on Biogen as well.
Yeah, please do.
So I know obviously it wasn't earnings. It was some sort of drug trial that, I guess, failed? Is that correct, or something like that? Or they didn't get approval?
No, they pulled their phase 3 trial. Didn't look like they weren't going to meet their endpoint anyway, so they just they scrapped it.
Okay, cool. So either way, it's the way from I view it as a technical trader, is that this was what I have coined as a disruptive gap, because not only did it gap down over 25% or 30%, it also wiped out over 2 years of gains or holders. So you have 2 years of long positions trapped underwater in one day. That is, in my view and opinion, particularly when it's a major large cap name, because you know that this is a name that's been held in any sort of biotech sort of fund or a hedge fund of sorts over the last 2 years. I've been accumulating it and holding on to these positions. And I believe the last I checked this morning, Biogen is, I think it's part of 15 different ETFs. So that alone is going to automatically have a lot of selling pressure on this stock today, because you have a lot of people in losing positions. You have a lot of funds that have to reduce their size. You also have these 15 ETFs that have to re-weight their holdings in Biogen just to keep those ETFs appropriately out there. Otherwise they're just going to get hammered completely. So it's just a lot of moving parts in a vehicle like this, and I agree with Damon. I would not necessarily be going after such names like this, because there's so much that pressure on this stock today. Now, give it a day or two, maybe it slumps a little lower, and then you see that all those weightings have adjusted and the funds have gotten out, and they've basically, like Damon said, they replugged the numbers in their models and they figured out a valuation for it. Then I think it's better off as a potential dead cat bounce type of play. Throw in the fact that too, month end is a week away, and this is a name that I don't think people are going to be. Why not wait until April? Get this name off your books. Cut your losses if you have to, and then dive back into it in April. So again, timing wise, I think it's off, and technically, I just think it's very disruptive action what we've seen here today. I'll keep it on the radar, maybe just going into April as a bounce play, but I don't like it right here.
Hey Scott, I got a question for you.
Sure.
This is chart trader Brett. So your disruptive gap theory, is it different for you for a biotech than other things, given that these types of game-changing gaps tend to be more common in the biotech sector than if this were to happen to like an Exxon or IBM or something?
You know what? I never actually thought about that. I think I actually started coining this disruptive gap thing only the last couple of months. But let's see. So if it's a major, obviously if that drug was a major source of income for the stock going forward.
It was their growth future, essentially.
Okay.
They don't have much growth in their other portfolio.
Yes, obviously that would be a little bit of a concern, yeah. Is it a factor for me? Again, I don't particularly like trading biotechs in general because of these gaps that can either make or break companies. But I'll just watch the price action. If I see a low risk opportunity to play a bounce, I'll jump in. But overall, I guess going forward, I'll have to start considering that for, whatever the catalyst specifically was. I'll have to figure that out. And
I guess the difference would be, I like your theory a lot. I think it's important. I guess the difference would be maybe there's more protective hedging with catastrophic options plays in a biotech, which might ease some of the overhead supply in a situation like this. But maybe that's not true, given your point is a good one, that it's also involved in a lot of ETFs that have a diverse exposure because it's such a big cap.
Yeah, I think sometimes we give too much credit to Wall Street in general being smarter than and well hedged. But if you look at history with long-term capital management and funds blowing up and over leveraging themselves and blah 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 and this and that, believe it or not, Wall Street's no better than you or me when it comes to this. Well, maybe I shouldn't say that, but they're just basically they tend to be blindsided quite frequently. Yeah. So, yeah.
All right, gentlemen. Does anybody have any parting shots they want to add? Something that maybe we didn't cover that is particularly compelling, a different market that we're not taking a look at, or have you guys pretty much summarized what you want to get out into the listening community?
Well, one thing that I would note here, just as an intraday point, with this big reversal in the dollar, I think a lot of people weren't positioned for the dollar coming back, and we're starting to see it hit other things, and copper has just started to get whacked. So it's just something to keep an eye on. If the commodity space starts to get taken down because of dollar strength here, it could kind of shift around some other assets.
Yeah, I think the pound weakness is really having an impact there. That's down 1.5% on the day now. That makes up about 12% of the Dixie basket, I think. I got to double check the numbers on that. But
you see the Canadian, the Australian, the Euro, they're all getting crushed too.
Yeah.
Not as bad, but...
Right. Yeah, and Euro, obviously, as you said, I think that's back down to that 113 level. So it kind of plays back into what I was talking about earlier with... The key question for the Fed is the Fed nervous about everybody else, or are they nervous about the U.S. economy too? And I think that's the difference between whether or not we get the pullback or the bubble in the U.S. markets is kind of how I see it.
Sure.
And what's not down very much is the yen, only down 0.2%, so underperforming the downside of some of the other ones. I'm looking at the euro, which is down about 1%. Gavin already mentioned.
Japan was also closed today too, right, Jim? You think that could maybe be a factor in the yen just kind of holding steady?
Typically, that doesn't have that big of an impact. Maybe Brett would beg to differ on that, but even when Japan's closed, the currencies will still move. So there's somebody out there in the FX community who are keeping close tabs on that. So I wouldn't really put a whole lot of stock just because they're not at the desk or have the day off. So
I agree with that, and I would also say it is really an interesting point in general, the way the yen is behaving today. I don't know what to make of it, but it's something to take note of.
One more thing that I want to highlight, a strong dollar isn't so good for the small caps, right, Brett?
Actually, it's
Or
better for the small caps.
Is it okay? So I'm going the opposite way, right?
If you
so
think about
weak
they're in a
dollars
position where they're selling to locals and they've got to import stuff. They don't have, right? So I mean, if you think about their input output,
cost.
right? So yeah, I mean, in relative terms, their input cost declines relative to the currency issue because they're purchasing things from foreign places with dollars. Stronger the dollar, the stronger their purchasing capacity.
Okay.
That's why I think if you're of the mindset that the Fed is just really worried about the rest of the world, in particular divergence of the central bank monetary policies with the ECB that's now further easing, BOJ that's threatening to further ease, then I think the IWM could be a winner in such a scenario.
Well, maybe that's leading to the outperformance here today. It is pretty strong, up over 1%, outpacing the rest of the broader market indices. All right, gentlemen, if there's nothing else, I just want to thank you all for joining us today, giving us your insight, and hopefully we get good response. And if we do, we'll do it again.